Well, there continues to be little relief in sight for the housing market, and as a result, more and more mortgages, as they're readjusting, homeowners are being forced to take drastic steps. Some are choosing what's called a short sale. Ted Lanzaro joins us now to tell us what a short sale is and what its tax ramifications are. Mr. Lanzaro is a CPA with the accounting firm of Lanzaro LLC in Shelton. Nice to have you on the program.
Thank you so much. Nice to be here.
All right, this is different from a short sale when you're investing in the stock market, when you short a stock.
Absolutely.
This is a completely different animal. Explain to us what a short sale is.
Okay. A short sale is when the bank agrees to take a lower amount than is what is now owed on the mortgage currently. Okay, so instead of going through the foreclosure process, they will, if you have a buyer for your house, and they're willing, you need to sell your house because you're about to go into foreclosure, and your buyer is willing to pay less than you owe on your mortgage because now that's what your house is worth, then you can negotiate a short sale, which means the bank will agree to take less payoff on their mortgage.
Let's say I owe $150,000 in my mortgage.
Right.
What the offer gives me is not going to allow me then to pay off that full 150, maybe only 100,000. So you're hoping that the bank will forgive you that $50,000?
That's what you're
hoping for.
That's what you're hoping for. That's exactly right. Yeah, and the reason the bank might be willing to do that is because they don't have to go through the foreclosure process, which is expensive and costly, and sometimes the house ends up on their balance sheet before they can sell it off at auction. You know what I mean? Mm-hmm. So it saves them from doing all of those things.
All right, we're making it sound really simple. And who wouldn't want to do this? It's far more complicated, and you really can get yourself into trouble. We were talking a moment ago about these same unsuspecting people who went into these subprime mortgages could once again be victimized by either bankruptcy, foreclosure, or this short sale process, couldn't they?
Yeah, this is not necessarily a great thing. I mean, it's something that has some tax effect. You're going to have to go to the bank and you're going to have to show them that you don't have the money to bring to the table for the closing, or that you're in a position where you really can't pay the mortgage. So they don't just hand out these short sales or cancellations of debt. They're given as a kind of a last alternative.
Yeah. What about the folks that say, I'm not going to do this. What I'm going to do is I'm going to declare bankruptcy. That way you can't take my house, and I don't have to go through any of this.
Yeah, well,
not a good option.
The bankruptcy has its own set of goods and bads. They have to be weighed. What I would recommend somebody do if they're looking at that alternative is to go and speak to a bankruptcy attorney, because bankruptcy now with the new bankruptcy laws is not the bankruptcy of old. There's a whole new set of issues, and if you have income and assets, it's not necessarily a great thing.
Yeah, can I negotiate this short sale with the bank? Can I, if I have $50,000 that I'm going to owe that I don't have, right, can I somehow negotiate this with them? Because I understand that some banks will give you a promissory note, for example. In other words, eventually you're going to have to pay that money back.
Right.
Can I negotiate that somehow they will completely eat that $50,000?
Well, in the short sale process, they actually do completely eat that $50,000. Mm-hmm. They literally, it's a cancellation of the debt, so you never pay the money back. Okay, but you get a nice what's called a 1099 from the bank for that cancellation of debt income, and it becomes income to the person to the homeowner. So now they get to pay taxes on that income when they don't really have any, they didn't have any money
to pay in the first place. So in other words, that $50,000, then you're going to get what, a 1099 or?
Yeah, you're going to get a 1099, and the IRS gets a copy of that 1099. So you definitely have to report that money as income on your tax return, and in a lot of cases you have to pay tax on it. There is some loopholes in the tax laws that allow you for it to be tax-free.
Okay, and some of these are what you call recourse debt or non-recourse debt, and explain the difference briefly between the two.
Yeah, recourse debt is when you are liable for any shortfall when you sell your house. Okay, so if you have a $200,000 mortgage and you get foreclosed on, and the bank can only sell your house for $180,000, you still owe the bank $100,000. You still owe the bank $20,000. Okay. If you had a non-recourse loan, you're not responsible for any shortfalls. So the bank gets what the bank gets, and that's the payoff.
How often does that happen, though, that you have a non-recourse debt like that?
Most loans in the state of Connecticut are recourse, to my understanding.
Okay, so count on the fact that if you're going to owe, you're going to owe money. All right. Well, Ted Lanzaro, thank you so much for joining us. A pleasure. Lanzaro CPA in Shelton. And that's all for this week. We'll see you next week on 12 on the Money. I'm Rebecca Surran.